Why do some people retire with financial freedom and others struggle and scrape through their golden years just to get by? Do you know the exact rate of return you need to retire with financial freedom after inflationary effects? Turns out just a few interest points can be the difference between a retirement plan that is a beautiful golden financial fountain of freedom or a retirement dumpster fire. Several years ago, my wife and I were making good income. We were putting a lot of money into the 401k. We were doing all the standard advice, everything people told us to do to have a beautiful retirement. Well, I built a calculator and I put inflationary effects into the calculator. Turns out all of that common advice was leading us more towards the retirement dumpster fire, not the financial freedom that we were promised. So I've been learning different ways to invest to create that financial fountain of freedom. Now, I am not saying you who are watching this video that you're headed for one or the other. I don't know. But what I am saying is you get one shot at retirement. You get one shot to prepare for retirement. So please use the free calculator. And if you need to make changes now, not try and make changes when it's too late. So let's get into it. My name is Brad Reed, and I would like to encourage you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. This is not financial advice. This is for education and hopefully some entertainment. There is no offer in this presentation to buy or sell any security, investment, no tax advice, accounting advice, or legal advice. Should you want such personalized advice, please seek a competent and hopefully licensed individual in your area. Okay, we got an easy 4-step process. Number one, interest rate matters. On the calculator, you can play with the interest rate so you can see what interest rate you need. Inflation increases the cost of living over time. This is where people get it wrong because at 4% inflation, the cost of living doubles every 18 years. So if you're 60 years old right now, and you want to retire, what is $100,000 today in 36 years after the cost of living has doubled twice? $100,000 today in 36 years, it'll take $400,000 to provide for that same lifestyle because of inflation. Your retirement plan and your investing strategy needs to account for inflation. So on the calculator, it has places where you can experiment with different inflationary rates. Okay, calculate the required inflation-adjusted rate of return. Don't just guess. Don't just get what your financial advisor tells you you need to get and be happy with. Calculate what you need. If you're not currently getting it, that's step 4. Compare your required rate of return to your current strategy. And if you need to do something different, then come check us out at Indomitable Horizons. If your current strategy is going to get you where you want to go, fantastic. Congratulations. So now it's time for you to get the free calculator. Go to https://invest.indhrs.com/IARC. Hit pause on the video, write it down. There'll be an investment or a form there at Indomitable Horizons, and you'll give us some information, and then we will email you the calculator. Because you only get one chance. What rate of return do you actually need? Okay, let's go check it out. There's 2 tabs on the strategy. The first one is what I call the sell your stuff strategy. This is the way the math works before I learned what I know now. But basically, you put a bunch of money into a retirement account, a 401k. It doesn't have to be a retirement account, but you put a bunch of money in an account. You invest it in various public equities, ETFs, mutual funds, 401k choices, or 403b or TSP, whichever you got, and it grows. And then when you retire, you sell off pieces of it to provide for your spending power. Now that's the problem, selling off your stuff and hoping that you don't die before you run out of stuff. So there are a couple of pieces to this. Enter your current situation in the yellow boxes in the upper left. So if I blow that up, first, what is the current year? I'm recording this video in 2026. In what year will you retire? I am 51 years old, so I want to retire in the year 2040 when I'm 65 years old. If you were retired today, how much annual income would you need from your retirement savings? when I'm recording this, the median income is $100,000. What if we want to retire at double the median income? That would be $200,000 a year. Now, in the year 2040, it won't be $200,000 because inflation is going to require that to be much bigger than today, and that's what this calculator is going to do for us. So, what rate of inflation will you plan for? I like 4% as a long-term rolling average. You pick the number that works best for you. I like 4%. And then, as my time as a financial advisor and working with several financial advisors, I think these are common numbers. But if you disagree with me, you get to pick whatever numbers you want to put in. But what rate of return will you seek during retirement? I put 6% in mine. What rate of return will you get before retirement? I put 8% in mine. Then how much do you currently have saved for retirement? I picked a big number. I picked $1 million. And we'll see what that does with the math. You get to put whatever numbers you want in the yellow boxes. Okay, the next one is to analyze this blue section over here. And what are the monthly contributions required? All right, so to achieve that $200,000 in buying power for every year through my retirement, it says the retirement saving goal needs to be $17 million. The big problem is, at the target retirement year, the current savings will only grow to be worth $3 million. And to reach the goals, I need to make monthly contributions of $46,922. Not many people that I know are able to put in monthly $47,000. So this is where we want to change the interest rates, change our retirement situation, play with the different numbers to see what we can figure out. We also want to look at the yearly results of our retirement savings and what inflation is going to do. So notice that $200,000 of income, the $200,000 of buying power in 2026. In the year 2041, it'll take $360,000 to get that same buying power. That's how inflation wrecks most people in retirement. Now, for this one, you can play with different interest rates. You can play with different incomes during retirement and figure out what is right for you and your family. If you cannot come up with anything that you like, go to the second tab. This is the Indomitable Horizons Inflation Adjusted Retirement Calculator, and use some of the strategies that we do. Now, there's a small difference, and it's in the yellow boxes. So the investment choices that we do, when you invest in something like an apartment, there is a cash-on-cash return that you get monthly, quarterly, or annually, usually quarterly, but not always. But you get cash flow while you are holding on to the investment. And then at the end of the investment, you get an equity bump. So if you put in $100,000 and you get 10% cash on cash return, you will be getting, or in this case, 8% cash on cash return. If you put in $100,000, you get 8%, you get $8,000 every year. And then at the end, you get back maybe $120,000, $160,000, but you get to keep all of the cash on cash that you received while you hold it. So the idea is that when the investment is done, your equity is more than what you put in, and you can reinvest, and therefore your cash on cash grows throughout retirement. All right, I'm got other videos on how to do that, so just look me up at Brad and Reed on YouTube, and there's lots of videos there. Or at the end, I'll show you our website, and you can get more information there. The other boxes are the same. Current year, what year will you retire? How much annual income, inflation rate before retirement. These two boxes are during or after you retire, and how much do you currently have saved. Now, what I have done is I used 12% before retirement, because that is if you put all the cash in cash and equity and reinvest it. We call that annualized rate of return. If you invest that way at a 12% annualized rate of return, and you get 8% cash on cash, and your equity still grows at 7% annually, you don't have to put any more in, because your retirement savings goal under this new way of investing is $4.3 million. And your current savings will grow to be worth $5.3 million. So you're good. No more monthly contributions. In fact, you can probably retire early. Congratulations. And then when we look at these numbers, instead of retiring in 2041, you can retire in 2039, just a little bit early. And that $200,000 in buying power in 2039 with inflation will grow to 333. But this is the calculator that I have built. Once again, experiment with different interest rates and determine what is right for you. So let's go play. Here is the calculator. Hopefully you've downloaded it by now. If you haven't, go to, I'll just show you here. It's invest.indhrs.com/IARC, and you'll get a form that looks like this. Type in your information, and you will get an email with the calculator. So this is the standard one that I showed you. You can play with what, if you were retired today, how much annual income would you need? And maybe we drop that down to 150, and we see that the monthly contributions drop to 32,000. That's still a lot. Well, can I get by on just the median income today? That still requires $18,000. Well, what if I drop that down to 50,000? Then I still need to make almost $4,300 monthly. That's around $50,000, I think, a year to put into your retirement plan. That's a lot, but maybe you can figure out how to do that. I don't know. $50,000 and putting a whole lot of money, sacrificing a lot, doesn't sound like a retirement dream to me. So let's put that back up to the median income at $100,000. And maybe instead of getting this financial advisor 8% performance, we get the long-term stock market average, and we risk all the volatility, and we bump the 6% number up to 8%. And that means if we can figure out how to get that, we only have to put in about $1,000 a month. And then you can scroll down here to see how all of this math works. It assumes that your retirement savings, you grow it at 8% each year, every year, which of course we know that's not going to happen. Sometimes the market's going to be good, sometimes the market's going to be bad. But the first 4%, which is the rate of inflation, gets reinvested into the retirement savings to keep it growing. And whatever's left, you can sell off, and that becomes your income. So this column over here shows your income adjusted for inflation. So play with the numbers, see if you've got something that works for you, that you like, and that you can get. Ask your financial advisor, ask your retirement fund administrator, hey, the way I have it all set up, what is my long-term annualized rate of return? Not recently, not when the stock market's just absolutely crushing it, but long-term, what is my rate of return? And you can put those numbers in here. Now, if that doesn't work for you, or you want to invest in, my research shows how the ultra-rich families invest, then you need this one. This is how Indomitable Horizons invest, and these are the investment types that we look for. Once again, there is a number before retirement where you take the cash on cash and the equity and you reinvest everything. So we call that the annualized rate of return. And then there's a number here, cash on cash. Again, you put in money into an investment and you get monthly, quarterly, or annual distributions. Usually they're quarterly. And then when the investment is over, you get your capital back and your equity back. And it is, if everything went right, it'll be more than what you put in. And therefore you can reinvest it, and your cash on cash in the new investment is more than the cash on cash in the old investment. So in this example, I have $1 million right now. I'm getting 12.5% annualized rate of return before retirement. During retirement, I'm going to settle for 8% cash on cash returns and a 6.9% annual growth in my equity. And I see I don't have to put any money in right now to get $200,000 in annual income in today's buying power. What happens if I ask for $250,000? I'm I'm going to get 250,000. What happens if I ask for 300,000? 3 times the median income. I have to put in $715.83 a month. That's not a crazy number. And 300,000, 3 times the median income sounds pretty good. You can scroll down here and see what these numbers will do with inflation. I've got it really zoomed in, so hopefully you can see this. But if I zoom out, it makes it a little bit easier to see. But you can see what type of annual income it's going to take. Notice $300,000 of buying power in the year 2026. When that is adjusted for inflation in the year 2043, it's going to take $584,000 to accomplish that. Play with your numbers, find out what is right for you. Now, if you want to learn more about how Indomitable Horizons invests, we merge two strategies from famous investors. Ray Dalio is probably known as the best investor of modern times, perhaps of all times. Tony Robbins and Christopher Zook recently wrote a book about some of these strategies. But the idea is to get diversified. Now, this one's not a shocker to a lot of people. But the idea is that diversification is spreading your investment money across different industries, different businesses, different revenue models, different sizes, geographies, economic sensitivities, so that the portfolio is not dependent upon a single outcome. I think most people understand diversification, but the problem is people assume that if they get some real estate stocks, some commodity stocks, some tech stocks, some of all these different flavors of stocks, that they are safe. And the problem is that the stock market, all those different types of stocks, they're 80% correlated with each other. And public equities in general are 60% correlated. The second factor, and Ray Dalio's holy grail of investing, is to get non-correlated. So non-correlated means that if one of your investments goes up, that you can't predict what the others are going to do. So for instance, if you have an apartment complex and you have some oil wells and you have some stocks and you have some private businesses, if the real estate starts doing really well, it doesn't have any effect one way or another on the other types of investment. If the oil and gas industry goes way down, it doesn't have an effect on the other types of your investments. So non-correlation is like diversification on steroids. So diversification, non-correlation, and the third one is asymmetric risk reward. Basically, this means if everything goes right or even everything goes as expected, the potential upside is significantly higher than the risk unit that you're risking if things do not go right. So we want big upside if everything goes well. We want limited downside if everything goes wrong. Now, that's Ray Dalio. Peter Mallouk also has something to say. His message is that much of the growth in the economy happens in the private markets. Another way to say this is, by the time a company goes public, a lot of the opportunity has already happened. So instead of investing a big chunk in the public markets, you need to learn how to get into the private markets. Indomitable Horizons can give you access into these private opportunities. So now this is not the Indomitable Horizons target strategic allocation. This is me, Brad Reed. This is what I'm shooting for. 80% in these private deals because, according to Peter Mallouk, that's where the growth is. 40% in real estate, because real estate has always been the largest asset class of the ultra-rich. And of the first generation millionaires, 80% of them got their wealth through real estate. 40% in real estate, 30% in private equity, 10% in energy. That adds up to 80% core private ownership. 15% in public equities. Now this can be stocks, bonds, dividend stocks, ETFs, whatever. 15% in public equities. Then 5% in alternatives. And alternatives include sports teams and venture capital. The challenge here is that to get into sports teams and venture capital, the minimum investment is huge. $500,000, $5 million, sometimes $50 million as the minimum investment to get access to some of these. So I have found a fund that I use that includes all this that I invest for my family. Okay, so this is my target strategic allocation. My buddy and I, Bijan Mirpur, we formed Indomitable Horizons Fund so we can give you access to these types of investments. Now, not every investment is right for you, so our fund is actually a customizable fund. Did I say that right? Customizable fund that you control. Most funds, you get whatever the fund manager tells you you need to get. They put you into an opportunity, and then they run off onto the next opportunity. That is not us. Okay, that's not what we did. What we have done. It's a customizable fund that you control. Technically, it's called a 3C5C. You can look it up. It means we have to do a lot in real estate. It's what we've studied. It's what I've studied. It's what Bijan's been doing for many decades. But we chose to focus on real estate because that is the largest holding of the ultra rich. If we do an equity deal, we are required to be general partners. That means that we will be at the management table for the lifetime of the hold on that asset. Again, we are not going to put you into a deal and then run off to the next one. We will be at the management table, making sure everything goes as well as it can. So here it is. We find the deals. We present to you the ones that we like. You decide. Invest or pass. Invest a lot, invest a little, or just pass. Wait for the next one. It's a customizable fund that you control. We give you access to these private investments. You can effectively build your own ETF. It's your retirement. It's your choice. Let us help you. So right now it's for accredited investors only. If you are accredited, swing on over to www.indhrs.com. Check us out. If you want to ask questions, I jumped ahead. Remember, it's a 4-step process. Know that interest rate matters. Understand the inflationary effects and how it's going to increase the cost of living. Calculate your required inflation-adjusted rate of return. Okay, folks, you get one chance at this. You cannot guess. You cannot just assume that what your financial advisor tells you that you need to figure out a way to be happy with. Okay, that's not good enough for you and your family. Don't do what the financial advisor says that you should get. Calculate what you need. And then if you're currently not getting what you need, try a new way to invest. Try us out at Indomitable Horizons Fund. So we want you to create your own financial fountain of freedom. We think that's what retirement is all about. They call it the golden years for a reason. You should be swimming in gold or whatever the digital equivalent is and going to be in the future years. Follow me on social media. I'm at Brad NR on Facebook. I'm at Brad N. Reed on Instagram, YouTube, LinkedIn, or at INDHRS Fund on Facebook, Instagram, and LinkedIn. Follow us, ask us questions, engage. But folks, you get one chance. I pray that your retirement meets up to your dreams, and always invest on logic, not on hope. God bless you.